Welcome back, everybody. While Palantir held an investor day earlier this week to build excitement around its planned public debut, now many investors are beginning to question the growth story there. Back in 2015, the company was valued at some $20.4 billion. But its updated prospectus now points to something more like $10.5 billion in total value. For more, let's bring in the reporter who crunched the numbers, Ari Levy. He's a senior tech reporter with CNBC.com. Ari, welcome. Good to have you with us. What happened to this company in 5 short years from a $20 billion valuation or imputed valuation to something half that?
Tyler, good to be with you. Thanks for having me. Really, Palantir, 5 years ago was a very hot company. We didn't have all the numbers, but the numbers we had, they looked like a big company and a rapidly growing company. What happened in the subsequent years is that it became clear that they were a very different kind of company than the typical cloud software business that has really excited investors. This is a very heavy piece of software. It's very expensive to deploy. They don't have very many customers. They're very concentrated in the customers they have. And so the growth story started to look more like a plodding along, trying to figure out what the future of the company is. Right now, they're in this interesting pivot point at the time they're going public, where they're trying to show investors that they do have this really big market opportunity, that they have a bunch of potential customers out there. And that's where the skepticism is. If you believe they're more of the plodding along company, then you're more on the 10 billion side. If you see them as a rapidly growing software company, maybe you're closer to 20 billion.
It is interesting, as you point out, this company doesn't have all that many customers, and several of them make up a lot of their revenue.
Yeah, and so this company got started as a government services technology company, providing technology to intelligence agencies as they were doing counterterrorism operations. They built out these massive sort of databases where these agencies could store and crunch data and information. They then basically, made that product available to the private sector, and they have really big customers like Airbus and BP. It's only recently that they've tried to make this a more easily deployable service that any company can sort of spin up quickly, try it, see if it's worthwhile before investing a ton of time and money into it.
A couple of things that would stand out to me if I were considering an investment in this company is that the company lost $588 million in 2019. In the first half of 2020, it lost $165 million. That is not exactly what you'd like to see, ideally, I suppose, on a pro forma or prospectus. And the other thing is the share structure would not be called best in breed, would it?
Yeah, so 2 interesting points. I think from the losses standpoint, tech investors, particularly those in software, have grown accustomed to companies going public with fairly hefty losses because sales and marketing and research and development are so expensive. Getting these things going and getting customers tends to be very costly. The payoff comes over time as these big customers renew, and so your initial sales and marketing costs turn into big revenue on the line. That's something they can deal with as long as those customers come, as long as that customer base goes well beyond 125. The share structure, this is a very sort of Silicon Valley orientation, even though the company is trying to move away from Silicon Valley. You're basically betting on the team. If this is a team that you want to get behind, you can get behind it. If not, you don't buy the stock.
All right. Thank you very much. Ari Levy, we appreciate it.